Hi, my name's Adam. Welcome to the channel. Thank you for joining us today. For those of you that celebrate Christmas, Merry Christmas. I know for my family, we open presents on Christmas Eve, so we're only a day away from that. And of course, my kids are very excited on that. I grew up, we did fondue on Christmas Eve. That was a tradition that we had. And then presents Christmas morning. My wife, she did a German platter, it's called. I won't explain it, but it's kind of this weird thing. I've talked about it on this channel before. And then they open presents. So we've kind of adopted that tradition. So we do the presents tomorrow night, so my kids are super excited. But if you do celebrate Christmas, Merry Christmas to you. And I hope you all have a very nice holiday season. Paying less tax doesn't have to be complicated. And in this video, I'm going to go through 5 ways that you can pay less tax in 2023 and beyond that aren't complicated. You don't have to, do a bunch of research and read books and whatever. These are very surface level ways to pay less tax. And I'm going to break each one down in this video. So the first way to pay less tax next year is going to be to contribute to your RRSP. And for a lot of you watching this video, you're not sure should I put money into my RRSP as I'm getting closer to retirement? I think my RRSP is already overfunded. I have too much money in there. Does a TFSA make more sense than an RRSP? So let me just address a few of those concerns. If you make more than $50,000, that's my general kind of tipping point for TFSA or RRSP. Now, with inflation so high, that lower tax bracket and income bracket went up a bit. So now it's $53,359 for that 15% federal tax rate in 2023. So you want to take advantage of that. So now instead of $50,000, it's $53,000. So if you make more than $53,000, consider using an RRSP. If you make under $53,000, I would stick to the TFSA. So for those of you that make more than $53,000, look to use an RRSP in 2023. If you're not already contributing, look to contribute. A lot of you will have work plans that might match you. If you put in $100, they're going to match $50 or $100 as well. Take advantage of those plans. Not only is that free money from your company, but it's also giving you a nice tax break on your tax bill for 2023 and builds up a nice retirement account. Again, the benefit of an RRSP is that it grows tax deferred. And the concept behind an RRSP and why it works so well is 2 things. A, tax deferred, so you're not paying tax on any growth every year. And secondly, you're in a lower tax bracket in retirement than you are today. And that's why there's that tipping point between TFSA and RRSP. For those of you that are concerned yeah, but Adam, I have a big RRSP already and I don't want to put more money in there. Look, a lot of you that have that concern are near the end of your career and you're in the highest income years of your career. Now is the time to definitely max out your RRSP. You're going to be in a much higher tax bracket today than when you retire. And that spread can be sometimes quite substantial. 20-30% plus. So you want to make sure you're utilizing that RRSP right up until the day you retire. We've had clients walk into our office with RRSPs in excess of $3 million. Okay, they've done a very good job saving into their RRSP, but they've also done very well on their investments. A few of those were Tesla or whatever it is. Now they're probably down a little bit, but we've had multi-million-dollar RRSPs, and it still made sense based on their income, what retirement looks like for them, income draw, all of that. Again, that's where a really solid plan comes into play, but the RRSP still made sense for them. So if you're wondering, do I have too much RRSP or do I keep contributing? My message to you is keep contributing, especially if you're in a high income tax bracket in kind of your final years of working, you finally got that last pay bump, maximize that RRSP and maximize your tax savings. The second easy way to save tax in 2023 is to give money away. The federal and provincial governments give a really nice tax credit on donations. Typically, it's going to be right around 50%. So for every dollar that you donate to a charity that can use that can multiply that and help people in need, you're getting back 50% of that in tax savings. So it's only costing you 50% of what you're giving. Now, I know a lot of you don't give. There's a lot of data out there that says most Canadians don't give. And the ones that give a lot. That's just the data out there. If you've never given before, my challenge to you is to find a charity near and dear to your heart that you can help out in 2023. Not only are you going to feel good about it, but it's going to help you in your taxes. And that's what this video is all about. So when you give money, it should be from the heart and it should be something you want to do. But in the background, it does save you taxes. It does save you money. It puts more money back in your pocket that way. So consider making a donation in 2023. Again, there's thousands and thousands of charities that you can make a donation to and get a donation credit. So find something that's near and dear to your heart. So the third tax tip in 2023 to pay less tax is to utilize your TFSA more than your non-reg. And what I mean by this is typically for the last few years, I've always told clients, look, if you haven't maximized your TFSA and you have $10,000 that you're saving up and it's for maybe a down payment for a house, or you need to buy a furnace in August of 2023 and you just have a short period of time, just keep it in a non-registered account. Don't burn your TFSA room. Because if you come across money somehow, that TFSA room is kind of burnt and it's wasted. But things change quickly. And with interest rates the way they are and your ability to get 3, 4, 5% on savings and GICs, I would recommend if you have short-term money and you haven't maximized your TFSA and you're not going to, you have no plan to, I would recommend moving, let's say that $10,000 into your TFSA. You're going to get 5% on that money. It's now a decent amount of interest. You want to earn that tax-free. If you leave that in your non-registered account, you're paying tax on any income that you generate. Now again, before you were generating 0.1% of interest, so it didn't matter. But now you're getting that 3, 4, 5% of interest, and it's going to create a bit of a tax bill. So if you haven't utilized your TFSA room, you have some short-term savings for something, consider moving it to your TFSA just because of interest rates going up so much. Again, this is kind of contrary to what I've always said, but things change and your plan needs to change. And this is one area where you can reduce your tax bill going into next year. The fourth tip is structure your investment accounts in a more tax efficient manner. We come across investment accounts all the time from all of you, our viewers, that partner with us to do a plan and we run through your investment portfolio and it's structured really bad. You have a TFSA, you have an RRSP, and you have a non-registered account. And you have a bunch of bond funds sitting in your non-registered account generating interest income. And then you have equity funds in your RRSP and TFSA. You want to swap that around. Again, there's 3 ways to earn money in your investments. There's interest income, there's dividends, and there's capital gains. So let's just, at a high level, if we earn $1 in capital gain, so if my stock goes from $1 to $2, that dollar of capital gain, only half of it's taxed. So generating capital gains is the most tax efficient way to have to pay tax. Dividends is second, interest income is third. When you look at a bond generates interest income. So we want to have our bonds in our RRSPs and or possibly the TFSA, sheltered accounts. In your non-registered account, typically you want to have more dividend paying and capital gain generating investments. As you head into 2023, take a look at your investment portfolio. Is it structured properly? Is it tax efficient? And if you're not sure, talk to your investment advisor. Have them kind of break down like what account is generating what type of income. And if you have a non-registered investment account that's generating income or a lot of interest income, you may want to see, does it make sense or am I able to kind of rejig the account so that I'm generating maybe more capital gains or more dividends in that non-registered account and shuffling that interest income into your RRSP that's tax sheltered. And the fifth and final easy surface level tip that I can give you for tax planning as you head into 2023 and paying less tax is to income split when you hit 65. There are a lot of you watching this video that are 65 and older that are either not taking money out of your RIF or have not converted your RRSP to a RIF and you're not taking advantage of the pension income splitting. So there's 2 parts of this. Firstly, you want to convert your RRSP to a RIF at 65 so that you can take advantage of the pension income tax credit, which is a $2,000 tax credit that you can use when you pull money out of your RIF past age 65. Now it can be used on a defined benefit pension plan earlier. If you have one of those, great. A lot of you don't. So when you hit 65, even if you don't need the money, move $2,000 from your RRSP to a RIF, a retirement income fund, and pull it out. That $2,000 is going to come out to you on a tax-free basis. The second part of this is when you convert your RRSP to a RIF at 65 and beyond, that RIF income is pensionable income and you can split that with your spouse or common law partner if you have one. And this is a great tax planning tool. And often we'll put plans together for people in their late 60s and they haven't been splitting income and they've been paying thousands of extra dollars in taxes that they didn't need to pay. So make sure once you hit 65, convert money from an RRSP to a RIF. If you don't need the money, just do $2,000. You don't have to convert all of your RRSP to a RIF at once. You can convert $2,000, pull it out of the RIF, and take advantage of that pension income tax credit. Or convert more and start drawing money, the RRSP meltdown for you, and start income splitting that money. Again, powerful tax planning tools that a lot of you are not using. So again, if you haven't subscribed to the channel, please hit the subscribe button. Again, Merry Christmas to all of you. Happy holidays. Thank you for putting up with me and my raspy voice. I'm still fighting another cold. My kids keep bringing them home from preschool and school. But thank you for putting up with me. We'll see you in the next video.